Well, I'm incredibly excited to get started. You should all be able to see and hear me. If you've got any questions, put them in the chat box. I will be answering them all. I will stay until they are all indeed answered. So welcome one and all. Let me know where you're from, as you usually do. I've got Peter all the way from New Zealand. Good morning to you. I'm going to share my screen straight away. I've got quite a lot to cover, so I'm going to stay quite disciplined with this. Do ask away your questions. I will answer them as I go through, but most probably towards the end, if that's okay. But do let me know where you're from. Marguerite is in Italy at the moment. Hello, hello. Welcome to you all. Raj, Himanshu, everyone else. Now, I'm going to be, as I said, answering every single question. I'm going to go through the markets. I'm going to go through why people fail in their pensions and their investments. And it's not just always procrastination or not knowing what to do. We're going to do and cover a lot of things. You can see there where I've put part of my free campaign for $1million.com. For those who don't know, it's my campaign to teach 1 million people, thanks to the internet, TikTok, YouTube, how to invest better. If you have not seen my YouTube channel, let me just share my screen with you. Well, I recently got this, so do make sure you do see everything on YouTube, which is the silver sort of thingamajiggy that they give you when you surpass lots and lots of people on there. But do have a look also at my TikTok channel as well. Okay, because what you'll find on there, which I'll as well, dear Sally, there we go. So that's the YouTube one. So there's a lot more content on there. Just wanted to make sure. Well, what have we got? 224,000 followers. So almost 250,000 on there. And TikTok is, I think we're fast approaching 500,000 on there somewhere, wherever I am. Oh, here we go. Profile. There we go. Now be careful, there's a lot of fake accounts as well. So we go, 434,000. It's a lot of fake accounts pretending to be me on there. So I've got the blue tick from TikTok, okay? So part of my campaign is all of those things, just making sure, and these webinars as well, making sure everybody's well informed. So getting right on with it. First of all, nothing I'm going to tell you on the stocks I mentioned and not solicitations for you to go and buy those, okay? James, John, Paul, everyone else, welcome. We've got Bamboo, we've got Hertfordshire, we've got all sorts of places. Welcome one and all onto here. So that's the first thing I've got to tell you. It is not individual advice. It's not a solicitation to buy. Also, past performance is not a guarantee of the future. Obviously, the world could end tomorrow for a start. Sometimes people think that, oh, this happened in the past, therefore it must repeat itself. We're looking at historical performance, a bit like when you hand your CV to an employer, you're saying, my historical performance should be a guide to how I'm going to perform in the future. Okay. And that's essentially what we'll look at. If companies have been doing consistently well, if they're generating a lot of profits, lots of cash flow, lots of revenue growth, i.e. sales growth, lots of profit growth, lots of cash flow growth as well. And they've been consistently doing that year on year, year after year. What we're saying is, well, management they're in the right place. They're a good team making the most out of the market. This ought to continue at least for another 12 months, let's say, and we'll review as we go on. That's all we're saying. We are not in the crystal ball business. So I just wanted to make that clear as well. Now, this is going to be the agenda, 4 parts to it. I'm going to give you the market overview in just a second. We're going to address the problems. How much do you need to retire? How do you invest? How do you buy a stock? Don't worry, most of you know how to do that bit, so that'll be really quick. And should you buy a stock or a portfolio? And I'm going to argue you should actually be buying a portfolio, not a stock, okay? Because how a stock behaves within a portfolio is different to how it might just behave independently. And you can get 2 stocks which are relatively volatile, both with, let's say, a 20% average return. But because you've mixed them, you get your 20% return, but with a lot less volatility. Okay. And that's what a portfolio is. And when you add in 18, 19, 20 more stocks or funds, that's what should happen. You want that same return, but a lot less volatility. So I'm going to argue why you should have a portfolio. How do you know when to exit? How do you know what risk is? In other words, whilst you're holding something, imagine your house. If you kept checking the price every day, you might think, oh my God, it's quite risky, this house owning business, because it goes down. And the value of our house has gone down 10%. But if you're not going to sell it, what the hell do you care? And that's the approach we're going to take to risk. But the problem with the markets is somebody's shoving the valuation of your house in your face every single day. Imagine somebody knocked on your door every single day and said to you, and over a period of a year, you went, oh my God, the house is worth 10% less than it was. You would probably panic. Of course, why don't you do that? Well, because nobody goes and tells you the price of your house every single day, thankfully. Okay, and we're going to take a similar approach to investing as well. I'm going to explain that to you to give you that relaxation that you should have in a pension, the peace of mind that you should have. And that's going to be our key focus for tonight, is making sure that everybody has that peace of mind that they deserve in a pension, because that's the end goal of it. I'm also going to start some polls. I'm going to ask you whether you think the FTSE is going to be high by the end of the year. There should be a poll on your screen now. Okay. And then I'm going to present you, with some solutions. How much do you need? When to buy stocks or a portfolio? And we're not going to be gambling and tip sheeting. Oh, buy this now, I've got a hot tip. That's not what we do. It's our pension. We're going to be professional about it. How do you buy? SIP, ISA, 401k, depending on where you are in the world. What to buy? Obviously, we're going to talk about that. That's what most people are only focused on. Where to buy? So I'll show you some brokers and cost differences in a second. And when to exit, I'm going to give you a little flow chart. So you've got a process and a business plan. You can leave and say, oh, yeah, I know what I'm doing. I know why, where, when, why, how to buy, and where, when, why, how, why to sell. Simple process. Life's easy when you've got processes. And then we'll do Q&A. Okay, so let's kick off straight away, first of all, with the market overview, just the politics first, and then we'll start looking at the S&P. We'll look at UK stocks, US stocks, how they performed over the past week, which ones I've bought, what I like, what I'm doing, why I'm doing the way I'm doing things. Before we do all of that, the headlines. Now, you're going to see a lot of fear headlines. I think one of the classic ones on my private Telegram channel, my public Telegram channel, I posted up. And if you're not on the Telegram channel, it's on alpeshpatel.com/links. Okay, on the Telegram channel, I posted some of these fearful headlines. UK bonds drop in global sell-off, pound sinks. Now, I do an update virtually every day and teach little bits on this on that channel. We've got 4,337 subscribers. It's free, okay, open to the public, so feel free to join it. It's alpeshpatel.com/links. alpeshpatel.com/links. Okay, if you're not already on it, and you'll see little snippets. It's a good way to learn, because I also show videos, and this is from JP Morgan Private Bank, and I'm going to show you that in a second as well. Now, these fearful headlines about the pound or whatever else, that's noise. We are here to invest. Ignore them. You're going to get a lot of them at the moment because the markets are all-time highs. So TV channels, newspapers are fighting for attention. To give you a good example of why you might want to ignore noise, JP Morgan private bank division showed this since January to June and how the markets moved in that time. And they've put every single major news item that's happened. Okay. And do you really think we were going to try and gamble every single one of those points? 1, 2, 3, 4, 5, 6, 7, 8. When we did exit because of moving prices as an insurance policy against further falls, that was an insurance premium. So if you do pay an insurance premium, having to get back in more expensive later, presumably as with your house insurance, the fact that it didn't burn down, you don't think, oh my God, what a waste. What we're not in the business of, just to be absolutely clear, is predict 1, 2, 3, Israel, Hamas ceasefire. I'm afraid the terrorists at Hamas did not consult me where they are on their negotiations and the impact that might have on the market, for instance. The Chinese didn't tell me they were about to launch DeepSeek. Okay. So we're not trying to trade each one of those. That's what traders do. We're not in that business. We're in the investing business. Equally, we're not going to pick market bottoms and market tops because that's gambling, right? So I just wanted to show you all of that. We're going to avoid the noise, and I'll explain that in more detail. But you're going to keep hearing more and more of these scary headlines. We're going to be in the business of ignoring headlines. We're going to be looking at the individual stocks and average prices and when to get out, or whether, as normally is the case, to stay in. 2022 is when we exited the market. Also this year, I think it was March time, exited for a couple of months because, March, April, May, couple of months, because it looked like it might be like 2022. The price to be paid for exiting is the insurance premium if you possibly have to buy back more expensive later. if the house doesn't burn down. If it burns down, you get to buy back cheaper. Well, you tell me. If the house doesn't burn down and you pay your insurance premium, do you feel stupid? I don't mind. So I'm going to tell you what my wife and son got back into first. They got in before me because I put them into the lifeboats first, and we'll go into what they own. Fear headlines. So ignore those. Copper all-time highs. I'm not going to be gambling on copper. Anybody who's going to ask me about either Bitcoin or copper, sorry, I'm not going to be doing it. I used to write speeches for a dear friend of mine. He was the chairman of the London Metal Exchange, Lord Baggery. And the London Metal Exchange does, I think, about 98% of metals trading around the world. Britain is the world leader on metals trading. Forget London Stock Exchange, metals trading, we rule the world. So the London Metal Exchange. So Lord Baggery is a copper man. I mean, he's passed away now. And Metdist was a major company he owned, and they produced metal. They took copper and tubing out of Malaysia and so on, but lived in London, Regent's Park, Ionic Villa. It's the two big properties next to the mosque in Regent's Park. There's one right next to it, and there's the one next to it, and they at one time were the most expensive residences in the UK. Anyway, copper for them, he would often say to me over the last 25 odd years, but sometimes traded like it was gold, ridiculous price levels. And it's a function of not just supply and demand, which the metal exchange and would try and control, of course, and try and match, but also all the other crazy stuff. I'm not going to be gambling on copper. I know it's all-time highs. You're going to hear a lot more about it. Not really bothered. Tariffs. He's talking a lot about tariffs at the moment. Here's the good thing about investing. You can ignore most things. You can read and watch the news like Warren Buffett does every single day, watches the news, but you don't really have to do much. If you're investing, if you're trading, you have to work like a nutter. I've written 18 books on investing. My first one was Mind of a Trader, so I know what trading involves, and it's very hard work. Rewards are potentially fantastic as well. But with investing, the great thing is you can ignore Trump. I mean, that's victory enough for most of you, I would have thought. And the reason is the market has now decided that whatever the hell he says, it's for traders to panic over in the short term. Longer term, taco. Trump always chickens out. So ignore the tariff noise in one direction or another. We just don't know which way it's going to go in any event. If you don't know which way something's going to go, why would you be gambling on it? You'd be stepping aside from it. By the way, let me know if it's the first time for you, for any of you on here as well. Earnings season is starting on July the 15th, day before my birthday, and with JP Morgan launching. So there's going to be a lot of earnings coming out. The word on the street, if there is a word, and if there is just one street, is even slightly exceeding expectations of earnings, the market will just sigh relief given all the turmoil we've had so far this year. And because there's a low bar, companies should do really well after earnings announcements, and if any drop, buy the dip. That's if there's a word. Now, when I was doing my Bloomberg TV show, you can see it there. That's how I would have summarized something. When I was on the board of Chatham House, which is, I'm not saying all of this to brag about my history. People done far better, more important things than me. But the point is, I'm drawing all that experience into explaining all of this to you and compressing it in. And what I'm saying is, it's looking positive based on earnings. The market is very much focused on earnings, and that's good, and those earnings are there. They weren't there during the dot-com bubble, which is why we were always anxious. We were trading momentum. We were thinking, okay, I can buy this stock because I think it'll be higher tomorrow, but it's purely on momentum. It's not on earnings because there were no earnings. And we were happy to do that because we knew it was going to be higher tomorrow because there was just momentum. At the moment, we haven't just got momentum, we have got earnings, albeit valuations are high. So I am being cautious, which is why I've not been all in until last week. Been very, very cautious. So late and slow in. That's just me. Okay. My number one job with a wife and child at the age of 53, with everything that I've done, is not to mess it up. Like many people who've got to that stage in life, it is to make sure you don't lose it. You accumulate, but you don't lose it. If I'm in my 20s, I'm thinking my number one job is to build it up, take the risks. Okay. So I'm a lot slower in, but I'm going to show you how, if you want to take a bit more risk, as some of my clients do, you could accelerate in sooner. Nvidia is now at $4 trillion as of today. I'm going to show you the other stocks which are lining up to do that. Meta has been stealing AI talent from the other companies like OpenAI. I tell you what's really important for you to know about that. The big companies who are concentrated in the US and the S&P 500 moves according to their size are the ones who can take the talent. They can either acquire it by buying out smaller companies, or they can just hire it. Now, some of the wage packages are worth about $100 million. I'll say that again. Some of the wage packages are worth about $100 million. Now, for those people who think some person in China or some startup in some garage is going to be out competing any of that, you're wrong. If you do happen to win the Nobel Prize in physics, and it happens to be something that can be used in developing anything to do with AI, quantum computing, or the markets, that $100 million is going to be coming to your way very, very soon. So what I'm saying is this concentration of a few companies ruling the market, there's a rational reason for it, because they can acquire the talent. Okay, clever as my 7-year-old son is, I don't think he's about to bring down Meta, right? And that's something that's been missed. I spent the best part of this morning with the Department for Business and Trade, with another hat that I have, working on, I don't think I'm revealing any secrets here, working on, in part, the UK government strategy. I'm not going to mention which countries, but UK government strategy on acquiring foreign talent. And by talent, I mean the potential Nobel Prize winners, to get them into the UK. Okay, and by get them in the UK, I don't mean a black bag over the head on a midnight private jet via Morocco. I mean by legitimate means. The acquisition of talent is the race, and the biggest players, and the UK is a big player with a lot going for it to be able to acquire some of that talent, is a key player in that area. Okay, and whether it's companies or countries, we're both in the same business, and I want to make sure. Hey, Paresh. So my partner Paresh, my colleague, I said colleague, partner. Don't want my wife suddenly to get worried that I've left her. Paresh is on as well. I think I'm sure there'll be a way I can invite Paresh onto here as well. Okay. Paresh, just check your email, because I think I'm about to send you an invite, which hopefully won't log me out. Okay, so you might see an invite. So that's the key thing. So I'm not worried that I own the 2 M's and the 3 A's, which I've had for donkeys, with the exception of 2022 and a couple of months this year. If you're not familiar with the 2 M's and the 3 A's, and I don't want my private clients to feel that I'm giving away any trade secrets, because I've mentioned these before: Meta, Microsoft, Apple, Amazon, Alphabet. Now, I don't have a problem with that. Plus, I've got Nvidia, as you'll know, and I'll mention some other stocks in a second, because they are the ones who are going to keep acquiring all the talent. That's not to say the rest of us should give up and not invent our next business. Maybe we should. Now, these are the largest market cap companies in the S&P 500, not in the world, not including the UK or Saudi Arabia or whatever. Okay, so Nvidia has now, as of today, crossed that 4 trillion. Of these, again, I don't think I'm revealing any secrets, so I don't want private clients to get upset, because sometimes they get very upset if I mention anything to the public. But I don't think it's a secret that my wife and son have got Nvidia, as have I, Microsoft. Apple, I haven't got back in yet, which I'll show in a second. Wife and son are in, though, because in this kind of market, felt 50-50 was the right thing to. Amazon, Alphabet, yes. Got Meta, yes. Broadcom. But it's not about the individual stocks, because it's suited to my risk appetite and my timelines. I don't want Tesla because it's just too bloody volatile, as I've said numerous times recently. I don't happen to have that. You will know that I've got JP Morgan from the start of the year, and Goldman Sachs, and held it throughout the turmoil most recently. Okay. And yes, got that. I'm not going to go through all of these at the moment. I'm going to go through some of these as we go on and through this process. Will they all get to 8 trillion and then eventually 4? I mean, remember, 1 trillion was considered impossible. Now look at how many companies are over 1 trillion. I mean, you know, Tesla was there earlier. Morgan Stanley, JP Morgan will get through there. If I had to put bets on which other ones are going to get to 1 trillion, that one, the real issue is when. Oh, possibly. And so I'm going to leave it at that for now. Anyway, let's go and look at the specifics in a second and look at, well, again, these problems. Let's address these problems before we go deep dive into individual stocks. Everyone always wants to know individual stocks, okay? I'm in pajamas. He goes to bed so much earlier. He wakes up about 5 a.m. to take his dog for a walk, which is not a metaphor for something. Now, problems. How much do you need to retire? How do you invest? How do you buy a stock? Should you buy a stock or a portfolio? When do you exit? What's the risk? And let's look at some specific stocks as well. So let's go to number 2 now. Well, I did this last week and I want to repeat it very briefly. 10% improvement would mean an extra £25,000 in a portfolio. That's what it's about. Okay, it's about not necessarily even a 10% improvement, maybe a 15% improvement. If you've got a $500,000 portfolio, 10% improvement, okay, it's 50 grand. 15%, 75. Okay, you go, well, Alpesh, we can do simple math. That's significant. If that happens, let's say you make that marginal improvement, and let's take you 2 years, and every 2 years, okay, well, 50 over 4 years, you might have an extra 100 grand, okay, because you did it twice in 5 years. Got an extra 100 grand. Rough and ready maths. All right. That's what we're about. We're about those marginal gains, not here's a secret stock. And go into that. Let's look at another way of the problem of low growth, which is the major problem I get emails on about all the time. Okay, Glenn, I'll answer your question at the end as well. Thank you, Glenn. I'm glad you like the public Telegram channel. I think a lot of people miss it. They don't know its existence. And it's really helpful because you can look at it on your desktop or on your phone, and it's sort of baby bits. I don't put nonsense on there. I only put what I think is really important. And as a fund manager, I see a lot of stuff crossing my desk. I only put the stuff that I think is important. It actually started off as a tool for me to communicate with my internal team, to tell them what I thought was important. And then I started sharing it with the public. Why not? Okay. There is a private one just for clients, but the public one is really good, if I say to myself. So here's the problem with low growth, which is the major complaint people have. Let's say you've got $300,000 or pounds in your pension. After 10 years, if your rate continues at that, which is your St. James's Place classical IFA rate, okay, you're going to, and let's say you put that in every year, okay, that's your end balance. And you might say, well, that's fine, Alpesh. Started with that, but actually, that's your contributions. The contributions were where it all came from. And that's why they're always telling you, because they're hoping you don't do the maths, do keep topping up your pension, keep adding more, because they can charge more fees off your own money. The interest or the returns were less than the starting amount after 10 years and were less than your own contributions were. Okay. Now, let's say you could get it to, and that's the market average for the S&P over the last, 15 years. So I'm not even talking about anything I might be able to do. Just the market average, okay? Just the market average is what I'm talking about. And what do you end up with? Well, that's 300, that's 10, okay? Now it's significantly different. Now you've got your money working for you and doing all the hard work, which is what you want. You want to be in a position where that's the biggest. You don't want your starting amount to be the biggest hard worker. You don't want your contributions to be. You want that to be the biggest. That's the market amount. That's not me. And I can't guarantee that. I can't guarantee the market's going to continue doing what it's done historically, of course. But that's the numbers. Now that's significantly different, which then begs the question, well, that's all well and good, Alpesh, but let's not be greedy. How much do we need to retire on? Okay, well, that's what you need. Your annual spend times 25. That's one of the many rough and ready rule of thumb metrics, which I think is probably a pretty good one. Let's put the maths into that, okay? And then we'll look at portfolios and stocks and how we might get there from where we're starting from. Now, let's say you've got £40,000 a year requirement. That's your requirement. Then you're going to need $1 million. Okay, because we're just using this formula. All right, it's a rough and ready one, and it's based on a series of assumptions about how long people tend to live and inflation. Okay, so it's not. I mean, we don't know how much you might die the next day, in which case you'll bloody need nothing. Okay, you might live to 150, in which case you're going to need more. Okay, we're talking rough and ready averages, and it's a good rule of thumb to use. Okay, now you might say, well, that's fine. I will reduce how much I spend. That's one way to protect yourself. The other way is I'll just increase my contribution. Well, they're two things most people wouldn't want to do: increase contributions or reduce their spending. Most people would say, mate, Wouldn't it be easier if there was some way of getting that higher? If I could just get that market average, the American market average, not the UK market average. The UK market average is that. Okay, the American market average in my SIP or ISA, wouldn't that be better? Okay, tax is out of our hands. What Rachel Reeves might produce next is out of our hands, but the pension rate is definitely coming through some form of wealth tax on pensions, pensions and property. Why? Because that's where the wealth is held. Where the hell do you think people hold their wealth? Regular people. Okay. They've tried going after rich people. The rich people left the country. So they're going to go after the people who won't leave because they're easy to get. You and me, we stayed put. We didn't move to Dubai. So where's the two places you've got money? Property and pension. I mean, if you've got it somewhere else, do let me know. But property and pension, you might have some just sitting around under a mattress. But she'll probably let you keep what's under your mattress or back of the sofa for now. Okay. So property, I'm not sure how they're going to target it, but pensions is going to be pretty easy for them to target because it's already locked up and out of your hands. A bit like PAYE. They don't rely on you to pay them. They can go straight to the pension company and say, we'd like 1% of everybody's pension in the UK given to the government. I'm not saying they're going to do that, but that's what's coming next. So that number to me becomes more and more important every time I see any government plan. I think to myself, yeah, I just got to keep straight and level. Actually, I want to try and do better than that. Why? Well, because of my know-how and everything else, I want to do better. But for the average client, I'd say if you're getting that, you should be happy. If you've got more risk appetite, hey, 25%. Well, 2023 and 2024, the market gave shockingly good returns. Nothing I did. I didn't make the market go. I'm not Donald Trump. I couldn't move the market to my whim. It did great. We did great. As a result, we just rode its coattails. Okay. So here's another way. What's your retirement number? You can take a picture of this. Feel free to take a photo. All right. This is based on the 4% withdrawal rule. Now, some people say it's too conservative. Some people say it should be a 2% withdrawal, whatever. I would say I'd rather be more conservative than anything else. 100,000 per year. You want to be spending in retirement, you need 2.5 million. You're only spending 30,000, you need 750,000. Okay, as a lump sum in your pension. Of course, the alternative is obviously to work later. Paresh and I were talking about this later. We said, do you know what? I don't know why we keep banging on about pensions. You and I don't need it. We're in a profession in which Warren Buffett has just retired at the age of 95. We're not like footballers where we might get injured. And then I pointed out to him, actually, we could get injured. We might sprain a fingertip or fingernail doing Control-Alt-Shift on an Excel spreadsheet. So I don't know, maybe he and I will have to. But I reckon we're going to keep going to 95. So unless you're planning to continuously work and you're pretty sure the income from your work is of the nature, I don't know, mine and Paresh's work is, then you'll probably be looking at a lump sum for retirement, and those are some good numbers. Okay, now take a picture of this. This is a useful pension checklist that I made. I'm not going to go through it all now because there's just too much to go through, but I wanted to give you all of that. Okay. Now, the other thing I wanted to do with this poll, marginally you think the FTSE will be high by the end of the year. Let me put another poll up there. 45% of you think it's going to be high by the end of the year. Let's ask you about the Dow. For the Dow, just read US markets generally, okay? And that poll's up. So take a picture of this, and that'll sort of give you an idea of your checklist. It's a pretty useful checklist because most people are procrastinating. They just don't pull the trigger on their bloody pensions. They just, I mean, it's admin. I get it. It doesn't have to be pension. It could just be a general investment account with a stockbroker. It doesn't have to be pensions. I'm just happening to mention pensions as a vehicle in which you hold stocks or funds. The other thing I want you to watch out for is this little checklist that I made. Just ask whoever your IFA wealth fund manager is all of these questions, okay? These are the things to ask them, and those are the action steps, all right? Get your latest pension statement for these fees. Ask them. They've got to provide you this. They'll bury it in page 55, footnote 67, sub footnote D, paragraph A. Okay, but ask them for that, please, 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 please. We're going to get these printed out, which is why it's got a WhatsApp number on it and a schedule a call thing, because we're going to get these printed out and just generally hand them out to people, maybe even on the street. I don't know. Maybe even do little posters. You can stick them up at home. I might even put it around my home, so whenever we get a guest, we say, hey, listen, do you know this? Have you done this? Okay, so let me continue with some of these problems and solutions issues, okay? In particular, stocks and portfolios. Let's look at those, and how do you know when to exit and risk. Now, one of the biggest problems I've always mentioned to you all is people don't know how to buy stocks. Okay, this is what most people's portfolios will look like, either through a fund manager, an IFA, wealth manager. I mean, basically it's spray and pray. Just buy a bit of everything so that you can, if a fund manager does it, they do it so they've got something on marketing literature to tell you each month and say, oh, well, this one went well. Well, of course it did, because you've got every single bloody stock in the market. One of them's bound to do well, isn't it? And if it's private investors, they do it because they've got FOMO. Others, it's completely empty. And the reason it's completely empty is because they just don't know what to do. And they don't know that all you do online, the way you do online banking, you can do online stock buying, okay? So I'll explain that. Now, for me, I've shown this before, it's really between this number of stocks. Now, it's very simple. We have, what we give clients is sort of a risk appetite diagram. And if you're more risk averse, you might hold more low volatility funds, exchange trade funds, okay, which, like, let's say a low volatility one, not necessarily the S&P 500, but something like that, okay? And you might hold more cash, maybe 20, 30, 40% of cash, maybe 2 years requirements of cash, okay? That's if you're more risk. If you're more risk loving, like a 20-year-old, you're probably going to have closer to this number of stocks. The reason fund managers are so rubbish at their jobs is, first of all, they spray and pray. That's one reason, okay? They just hold a bit of everything. There's a whole bunch of technical reasons, one of which is they're in the business where they're paid by assets under management. So they maximize the assets under management because they're paid fees on that. So they want to get, say, $1 trillion of assets under management. And therefore, they've got to put money into a lot of companies. Otherwise, they'll end up taking over some of those companies, and they don't want to be doing that. Now, that's not your problem, and it shouldn't become your problem. It'll be a nice problem to have when you've got $1 trillion yourself. But if you haven't, why is their problem your problem just because you've outsourced your retirement and your kids' inheritance to a muppet like a fund manager? Instead, what to reduce that problem you should be looking at is somewhere along there. Now, the mathematics behind it, if you want to go into it all, the work by Eugene Fama in particular is good. He's an economist. He won the Nobel Prize in Economics for pointing out how bad fund managers are and why they underperform the market, and showing the mathematics of why they must. One of the other reasons why they must underperform the market is they're picking from a very narrow gene pool of stocks. They might have a UK fund or a growth fund or a value fund, but why don't they have a global, I'll just pick the goddamn best undervalued high growth companies? Why don't they do that? Warren Buffett does that. Okay, it just so happens the global best valued, unvalued high growth companies he keeps picking happen to be American. He's got one or two Chinese ones, but generally, you know, when they asked him, why don't you look at something in the UK? I think he looked 15 years ago at Tesco and then thought, no, can't find something decent in Britain. Okay, so that's one thing. The other problem is that you don't know when to let go. I'm going to give you a little process which is going to help you with all of this. By the way, you're all a lot more confident on the US than you are on the UK. I'm sorry I'm speaking rather quickly. I've got quite a lot of material that I want to cover with you. Okay. Now, you don't know when to let go. You don't know when to exit a stock. Okay, so you're sort of married to it. You bought it and to do, head in the sand. Everyone, it's like me and my gym membership. All excited in January, still paying for not going. So I'm going to give you a little plan in a moment. And the other problem is you don't know where to look. And so what you end up doing is magazines, newspapers, get over caffeinated, and like a nutter, just keep hitting the buy button. So instead, the bit and the approach that I far prefer on that, I'm just going to go to this because I'm going to share with you something confidential if I can pull it up. Yes, I can. I want to make sure. Oops, good job. I just did that. I'm just going to show that I don't share anything which is proprietary. Let me just move it down. Here we go. So I'm going to share the screen, and there we go. Okay, now what we'd prefer doing is sharing this with clients and giving them all 10,000 companies that have to meet all the major criteria you would expect by common sense. We don't use common sense. You know what? We actually use academic research and research out of the major banks to say undervalued companies. Now, you might say it's common sense. Undervalued companies tend to do better than overvalued ones. High growth ones rather do better than low growth ones, and so on. Cash companies generating lots of cash, which is this, tend to do better than ones which aren't generating much cash. You might say, well, it's bloody common sense. Yeah, but we had to put numbers to it. And this is how we did it. Okay, companies which consistently have high average stock price returns and very low drops from those and recover quickly, i.e. resilient, which is what this measures, Sortino, tend to do better. Now, none of these meet our criteria because we have a very high bar, because guess what? I gave you a clue why we have a very high bar at the beginning of this webinar. I mentioned my wife and son, and one or the other would kill me if I didn't have a very high bar. So that's one way to do it. You just filter that and select for your own volatility the portfolio based on that. And I'm going to show you some names from that in a second and how that portfolio is created. Solving some of those problems I mentioned in terms of brokers. I'm not sure if this is their latest pricing list, but there's a whole bunch of brokers. Also have a look at interactive brokers as well. They're like online bank accounts for people. Sorry if I'm teaching anybody how to suck eggs, but interactive brokers as well. Have a look at them. Whether it's a SIP, ISA, or a general investment account, and you're buying, I don't know, Microsoft, or you're buying British Airways, or not British Airways, British Aerospace. Okay. You can compare their various fees and all the rest of it. Watch out for that one. Watch out for them converting sterling to dollars back and forth and all the rest of it. And I'll answer other technical questions later. But these are probably some of the bigger names. And as I said, interactive brokers is the other one I'd probably throw in there as well. These can be a bit expensive. These can be, horses for courses. Okay. The reason I mentioned SIPs, and again, I'm going really basic with people who don't know about this. They're just like an investment account or a bank account, which is tax-free. You put your money in, the government adds a bit, so isn't that great? Gains are generally tax-free within it until you withdraw, and there's certain things you can, certain amounts which then get taxed at the end. You can have UK stocks if you really want. There's not many good ones. Exchange traded funds, which are like index trackers, generally think of it like that. This is where the bulk of my money is, US stocks. I don't want investment trusts because the fund managers are rubbish. If you find a good one who's consistently good, let me know. Doesn't happen, don't exist. Statistics proves it. Okay. REITs, not my thing. Bonds, I'd rather give it to my bank or use Flagstone to open multiple bank accounts where I'm getting about 4% because they invest in bonds. Rather than me doing it directly, I'd just rather the bank invested in bonds for me. You can tell if the bank account is investing in bonds with your money because you'll get an interest rate closer to 4%. And if they're not, like say Lloyd's Bank current account, you'll get 0.1%. So that's how you know. And they could still be instant access. Now, this is not a recommendation for this particular broker, but I'm saying there's a lot of them. And sometimes people ask me, how do I open a pension? There you go. You click that. You go to the broker, you click a button called open a pension, and they walk you through it. And they're so good. Whoever they are, all the brokers are very good that I've already mentioned. And yeah, they have awards and so on. Alternatively, you transfer. There, you click a button, they transfer it for you. It's pretty bloody easy, whether it's Barclays Bank or Hargreaves Lansdown, AJ Bell, whoever it is. Okay, so you've got that. And then how do I buy and sell shares up? It's just in case you didn't know. Well, there's an app or there's a website, and you go buy, go sell. Simple. And it could be a general investment account, it could be a SIP or ISA. They have different tax implications, each one that you use. All very simple. So let's get to where we are. Now, of course, well, what do we put in it? What do we put in it? Everything isn't NVIDIA. Okay, when in January 2023, this popped up on our approved list, it wasn't because our approved list of value, growth, income, new AI is going to be a big thing. It's because the valuation of the company for the earnings it was producing, the profits it was producing were low, and it popped up as a green. And then the other factors popped up as greens. It was as a result of that it ended up in the portfolio. Did we know what it did? No. I still thought it was making graphics cards for mining crypto. It wasn't at that, well, it still is, but it was really through AI. That only came out, I think by then you knew it was AI. It just popped up on the list. Should I, in hindsight, have bought this and nothing else? Yeah, but I didn't know it was doing all of this. The point is the computer has an opinion, not me. The computer has an opinion. The computer comes up through the filters of undervaluation. Now, if you think undervalued companies are bad, then you shouldn't actually be allowed near sharp objects. If you think companies which are growing are bad, then you shouldn't be allowed near sharp objects. All we're looking for is undervalued growing companies with generating cash. Why? Well, Croakey comes from Goldman Sachs Wealth Management. Value growth income comes from Richard Thaler, Daniel Kahneman, Eugene Fama. If the names don't ring a bell, they've all won the Nobel Prize in economics in the last 25 years, and they should be more popular names than Dua Lipa and God knows who. I can't remember. Cliff Richard. Okay, they're not all going to be like this. If they were, I wish they were. You would say, I've got a crystal ball. I wish I had. I don't. In hindsight, I should have put everything in this and nothing else. Maybe even today. Whilst we still own this, there was a period here, I had to exit it, and then wife and son got in first, me a bit later. That was the insurance policy against the falls, because I was worried it was going to do this, what it did here, but it didn't. Doesn't look like it's going to. So there was a bit of an insurance policy where, had I held on, I would have seen a big sharp fall, then a bit of a recovery. In the end, I ended up getting out there and buying back a little bit more expensive. So be it insurance policy against the house burning down, which was this. Didn't happen. That tends to happen about once every 7 years, roughly, with most companies. Most companies which are of sufficient quality, obviously, and the sufficient quality point being this. Notice how it goes from bottom left to top right. That's a pretty good indication of quality. Anyway, the point is they're not all like this. Let's be absolutely clear. Some things are like PayPal, which we had to exit, okay, because it was turned out to be a stinker. So not everything goes up. Let's be absolutely clear, because this is the bit that people have so many bad assumptions because of what they've been taught by parents or reading magazines or newspapers or TV. It is not about being right all the time. It is about a portfolio over a period of time. Warren Buffett isn't right all the time. That's why you don't have just one stock, because if you're going to be right all the time, just have one stock, have NVIDIA. Okay, it's not about trading. It is about investing over 12 months to 5 years. You might be holding something 5 years and then review. You might hold it for 12 months and then review. If you hold it for 5 minutes and review, there's something wrong with you. You're trading. It's not about gambling and speculating on news. You're ignoring the noise. It's not about trying to outsmart or get ahead of the market. It's about riding the coattails of the best companies. You're not trying to get ahead of the companies. You're trying to be behind them as they rise. It's not crystal ball gazing. It's about just waiting patiently for the damn things to get a return. The classic example being Microsoft 2021. It got a 50% return in a year, but 9 of those 12 months, it was down or sideways. Did I know it was going to go up 50%? No. Did I know it was going to spend 9 months going down or sideways? No. So what did I know about it? It was on the list. It ticked the boxes of undervaluation, growth, and so on. It's not about panicking. So by the way, I don't have that time machine. Those headlines, and that's not me. Okay, it's not about panicking. Having a plan for quality companies held over a period of time, that's what it's about. Again, I'm going to give you a little flow chart and plan in just a second. Investment strategies for different risk appetites. Now I'm going to go through this, but you can hold this. If you're risk loving, you could say, well, when do I buy? This answers that problem of when do I buy, Alpesh? When do I buy? Well, you could go all in, or you could go in tranches, okay, or longer tranches. What are the pros and cons? Here's the advantages. Take a picture of that. Feel free. I'm not going to go through every single thing, okay, because it's self-evident what I've just said, okay? Do that instead. Put another way. Of course, if it's the rise, the market's going to go up, down, sideways, okay? Now, if they go up, we're less worried. If they go sideways, we're slightly not worried. They fall, that's the bit. So I've given 2 parts to fall. If they're rising, well, it's simple. You don't do anything. Okay. If they're falling moderately, well, if they're quality companies like a Microsoft, I probably want to buy more. Okay. You want the kind of companies where if they fall a little bit, you want to buy more. This is the one to worry about. What if it's a severe fall like 2022, where it fell for the whole year? Well, either you can exit because you need that certainty. You might have a 25% stop loss. And you say, look, I need the certainty. I don't care. I'm willing to just get out. I don't care. Okay. Or you say, well, no, it's part of a model portfolio, which I'll hold through those falls and I'll wait. And that's that. Okay. Now, some people are like this. They're a bit more jittery and they want to get out. The risk of that is they get out at a loss and it's a loss they've taken. Or people say, well, model portfolio. What we discovered amongst our clients, and this is really interesting, only 10% are like this, which surprised me. I thought more would be like that. 90% want the model portfolio longer term hold. And then in a sideways market, again, you're just waiting. You're being patient. You're waiting. Okay. I'm going to put this in another way. There's only 3 parts to investing, and these things are really important. We create these for clients so they are always calm and they've got a plan of action. You've got the emotional. I'll buy, stock drops, you panic sell, market recovers, you've missed the gains, you've got a permanent loss. Okay, you want to avoid that one. That's the one we're trying to avoid. You're going to be B or C. B is buys, stock drops. If it drops, if it rises, you've got no issues. Now, you're either going to hold or add, because it's got cheaper, like a quality stock. Market recovers, you've got the gains. Path C, buy, stock drops. You sell because you either want that certainty of, listen, I'd rather be out, 25% stop loss. I don't mind if I've got to buy, or a daddy bear, don't mind if I've got to buy more expensive later, because you want to avoid the steeper falls. Somebody like me, more likely to be a little bit more like that, because I'm trying to protect assets at my age, whereas others might say, well, actually, no, I'm okay, I'm going to wait, I'd rather hold out. So like wife and son, they're like this person, I'm that way I've hedged my bets. Wife and son are that, I'm this, I'm always winning. Basic, I, as in the family, is always winning, because half of us are always right. Okay, buy back later, possibly higher, that's the insurance cost, controlled risk. Okay, you got a choice. What you don't have is, oh, I can pick the top and the bottom. Doesn't happen. Warren Buffett will tell you that, right? Put another way, you can either, which is only what 10% of clients do, can either go through 10,000 stocks, 6,000, and then you filter those and then cross-reference them by which ones the biggest hedge funds have, biggest banks have, and so on. Or you just have a model portfolio, which I'll show you in a second, where it's got good, strong historic returns. You see all the stocks. You can see that as a portfolio, its drawdowns are under 25%, though individual stocks might drop more than that, but it's counteracted by ones which go up, i.e. diversified. And you make it bespoke to you and the stocks that you particularly like. So you say, well, I like that cake you've made for me, but I take the cherries off. Whereas this is where you're putting the recipe together yourself. Those are 2 options for most students. In your own world, whether or not you're with me, in your own world, you can either build it yourself or you take a ready-made portfolio. The mistake people make is they think they're buying stocks. They're not. They should be thinking about buying portfolios, okay? Because that's what gives you the ability to own something with a bit more risk and volatility and return with something a bit more stable, and balance those 2 things out so that you can get closer to those kinds of numbers, right? You can take a picture of this if you wish. So again, solving that problem of what do I do with my portfolio? How do I know when to exit? This is what I give my clients. You can use this if you wish. Okay. I don't think, again, for private clients, I don't think I'm revealing any deep down secrets on this. Okay. That, I think, when clients have that in front of them, they go, right, I know what to do. I can be calm. I've got my portfolio and now I know what to do. I don't need to keep staring at the market. I can go and enjoy summer. Pension sorted. Tick that box. Enjoy summer. Tick that box. All done. Sorted. Okay. Again, like I said, take a picture. Mick, I'll answer your question in just a second. Kay's asked, trading 212. Well, trading 212, compare it with the others. I mean, trading 212, AJ Bell, Hargreaves Lansdown, Free Trade, they're all much of a muchness. So they're all the same. Hedge against US government debt. Manu, what exactly are you worried about? We're going to get into the realms of, you don't need to worry about US government debt, okay? And if you think I'm wrong, the best way to hedge against US government debt is find a new planet to live on. Have you seen the data of how big that country is? If it goes under, yeah, we're all going to be going and living in caves. Stock up on water, I guess. Okay, so let's look at some more of these solutions and in some more of the Q&A. Let's do the market, actually. S&P 500, this is where we are. Now, the worry when this was happening, these are average prices. Short and medium-term average prices is what is represented by the MACD there. And my worry was it was going to be like this. It could still be like this and do this. Okay, it could still do what it did there because the pattern was very similar and still is rather similar. Okay, so don't think, oh, yeah, we can just gung-ho. Wife and son are in the S&P 500. They're in what I call the Quality 5 Plus, which is about 37 odd companies. I edged into those slowly, slower than them. So I ended up paying an insurance premium by being out and missing this. Also meant I miss that bit. Okay, so I had to sell there and buy back more expensive, which is the insurance cost I was willing to pay. They well, not with all the stocks. JP Morgan, Goldman Sachs just held on throughout it. But the point is, if you don't want to pay the interest premium, that's fine, as long as the market does this. If it does this, then you've got to suffer the pain for a long period of time, and that's my concern. I didn't want to be stuck in the market for 2 years in case it went and did that. So where we are, it's a bit overbought, so cautiously entering is fine. Wife and son in the quality 5+, and I'll mention some of those names in a second. And I am now having edged in over a period of time, with the exception of 1 or 2 stocks, and I'll mention which ones those are in just a second. Well, Apple is one of them. Not in yet, I'll wait. Don't worry about that bit. Advanced Micro. We've got others. I'm going to mention 1 or 2 names. Again, I don't want private clients getting all of a sudden upset. I'm mentioning them belatedly, as it were. So yeah, okay, in, fine, happy, 3 years, 3 years. So anybody who goes, oh no, but it's dropped back, don't care. It's 3 years as part of a portfolio. Because it's part of a portfolio, I don't care holding it for 3 years. It's not meant to be there for 12 months. We're not gambling for 12 months on that one. See that one? Yes, have that as well. Okay, now these earnings are coming out next week. There's a lot of earnings coming out. They're probably going to be rather good. The market is less concerned about earnings, other than the fact that earnings are generally good. And if 1 or 2 companies suffer, they get hit, but they bounce back. A good example being last year, when I think last year or the year before, when it happened with Palo Alto Networks, gave a slightly iffy statement, got hit, and then boom, recovered like crazy. It's in cybersecurity. It's run by a friend of mine. The CEO is Nikesh Arora. Now, okay, so look, I've already mentioned I own that. So just to give you full disclosure, okay, on that. Now, past week, that's how it's looked. That's how it's looked. What do you want me to tell you? Not much to tell you, because a week is noise. And anybody who tries to read too much into a week for an investment, they're a nutter, because they're trying to say, oh, it's happening, is it sector rotation? They say, no, it's irrelevant what's happened in a week. Absolutely irrelevant. It's noise. Past year, this is how things have looked. I tell you what's interesting here, which is why my teeth are starting to itch with excitement, is that's been producing tons of profits, which are now in the balance sheet. So its share price, as a measurement of its balance sheet price to book ratio, which is Warren Buffett's favorite measure, and he owns 25% of Berkshire Hathaway's in that stock. That's got suddenly extremely cheap, because the balance sheet has been boosted by all of last year's profits. Because what happens to profits at the end of the year? Well, those that are not paid off in dividends, they end up on the balance sheet. And that means price to book ratio, what's on your balance sheet effectively, is pretty good looking. Now, okay, so that's where we are. Cheap. Given that in a whole year, both of those have had the same thing. Adobe, I might look at separately. I'm not, that should have done better. That should have done better. That's been disappointing for ages. Intel, by the way, that's AMD, by the way, and that's Qualcomm. But we'll look at some of those separately. But what I would say is that's America for you. You've got your 41%, your 20%, your 42s, your 14s. That's been, again, another one like this. They're going to do well. Palantir's, CrowdStrike's, Nvidia's, and all the rest of it. It's a lot of green. Great. It's a lot of green. I'm not going to go through every single one of these stocks. I know some people love Netflix. I don't have anything against Netflix. Disney's up 23%. Anyway, I'll go through some of them in the forthcoming slides, mindful of the time. Paresh, sorry, of all the people to go. Oracle has indeed done well and will continue to do so. It'll be more volatile than the others, because it historically has been. So it's one of those where if something's volatile but you still think it's going to deliver a result, and Oracle will, then you need to give it a longer time frame and not stare at it. Okay, otherwise you'll have heart attacks. Oracle's in that category, whereas Microsoft's not. Microsoft doesn't give you a heart attack. It's a boring company, and so a bit easier, if you see what I mean. But yeah, Oracle, that's my analysis for Oracle in a nutshell. So that's where we are with how the past year's looked, but it's been bloody hell, one hell of a ride, hasn't it? For your 12%, you've really paid for it. And we're only we're in July at the moment. That's the past 1 year. Okay. I do own that. I can't remember if I own Oracle, but Microsoft I do own, and yes, I have that. And this I'll be getting soon again. It's one of the Quality 5 Plus. So I tend to normally would be in it unless we're in a daddy bear, but at the moment it's been falling a little bit. Apple, and I think the bottom's been hit, but I'd rather just wait. But that's just me. Okay. UK stocks, I will do a separate video on. I also, to add extra zip, and it's a way in which I get extra returns, is do calculated risks on 2 times leverage. Now, I'm not in this one at the moment. Leverage should not be used by anybody else in their pensions because it is not suitable for pensions for people who just, I don't know you, okay? But I do use at times judiciously, cautiously, as you will know if you've been following me, to get extra returns, 2 times leverage on the 2Ms and 3As, Meta, Microsoft, Apple, Amazon, Alphabet. Okay, I feel like almost like I'm confessing doing cannabis or something. I've never done drugs. Yeah, so I do 2 times leverage sometimes. Yeah, it's cheating. It gives me extra firepower. It's adding nitrous to the petrol tank. Okay, it's like adding triple shot cappuccino to my oat milk. Now, Microsoft, yes, okay, obviously. And by the way, if ever you want to know when and why I'm in it, it's a really simple algorithm that I have for Microsoft and the 2Ms and the 3As. Okay, if the short and medium, this is short and medium term prices. If the green is above the blue, I'm in. If the green is below, I'm usually out. But if the green is below the blue, the earliest I could ever get in is when it's just starting to rise. Okay, so simple algorithm. Don't try and copy the algorithm. You can just watch the broadcast. So back in to all of that from, in my case, edged in after my wife and son. They got in sooner because I got them in, when did I say? What are we now? July. So got them in May. But I came in later in June, okay, in little bits instead. Sorry, there's fly infestation. So where are we on NVIDIA? Okay, yes, wife and son, same issue, same as Microsoft. Here's a very good, again, take a photo of this on your camera. It's a very good tool for deciding whether you should be in or out. 1, 2, 3, 4. And it is based on regret minimization, which is a hell of a lot better than trying to predict the market. It's a way of ensuring you're always winning. What I mean by that is that you can't control what's going to happen with the markets, and you don't know what's going to happen with the markets. If you try and guess what's going to happen with the markets, you're gambling and you're guessing. So instead, it's far better to mitigate regret so that you're always winning. If you got out, as I did earlier in the year, and then got back in at a slightly higher price, I was still happy because I minimized regret, fear of falls. Equally, if I stayed in, as I did with Goldman Sachs and JP Morgan, then I'm equally happy because I minimize regret. Do you see what I mean? And that's a hell of a lot better way. Okay, if you're smart, you don't need leverage. If you're not, you shouldn't use it. Wise words. Yeah, maybe I'm not smart, but it's worked out fine for me at the moment, just adding a little bit of extra zip now and again into that. Incidentally, Warren Buffett, I think, who said it, uses leverage. People don't realize it. It's about 1.2, 1.3% on the overall portfolio, because through their insurance blocks, they can borrow, as many cash-rich companies, to people's surprise, do borrow at low interest rates, and then apply that and buy stocks. And they can own more than 100% of their assets. Why would he use, therefore, de facto leverage? Because he's pretty bloody confident on Apple. So he says, well, I can only buy $1 trillion worth of Apple, but I'd really like to own 1.2 trillion. I know, let's borrow a bit because we'll earn more from the rise in Apple than we will from the cost on the interest. So yeah, leverage, which is dangerous, is, 10 times, 5 times, and so on, etc. But like I said, nobody should use it on here because it is a sophisticated weapon of mass destruction. I give my students 2 slides in which to give them a mini MBA on becoming their own fund manager. These are them. And those slides I've compressed 25 years worth of books and education into, each one of these is a video, each one of these is a document. Okay. These are the 2 pages that I give them. The reason I'm showing you this is to say to you how I think it can be simple to learn and get up to. A bit like those executive MBAs, you know, they used to be 4 years, and then the MBAs became part-time, and then they became evening schools and all the rest of it. This is the executive MBA that I give them, because these are the most important questions that need answering, and these are all the videos. And each video is about 3 minutes long. And the reason I created this was it was to train staff in my fund, first of all. Only later it became, well, why don't we do this for clients? But anyway, like this one. How do I monitor? Okay. By the way, if you want to monitor, and there's some great free sites. Yahoo Finance is good. Google Finance is good. Let me just answer a few of those questions. Okay. Do sectors matter? No, we're looking at companies, not individual sectors. What I'll do in future webinars is go through some of these. Okay. And here I show the risks with leverage. So for now, I'm going to tell you all, don't do leverage, for instance. Okay. But I'll answer some more of these so you get these bit by bit in future webinars as well. Okay, what if I need reassurance? I just showed you that flow chart of regret minimization. You shouldn't need it. Do the stocks go up? So here we show how a portfolio works over time and how steeply some falls can happen. Okay. These are the various personas. Take a photo of this as well. You're going to fall into one of these categories. What I've discovered, most people far prefer having a portfolio, a model portfolio, than trying to build it all themselves. This is building it from scratch with a recipe card. The recipe card and recipe, the ingredients are all these stocks. The recipe card is make sure all of these are green. Okay, most people would rather the portfolio done. So I'm going to show you a ready-made portfolio. So they go through all of this, and then they eventually come to the conclusion, actually, I'd rather just have a model portfolio. Now, they have to be led to that conclusion. You can't just say to them, you must do this way, not the other way, because how do you know they're not the 10%? And also, they need to see all of this. What were the ingredients that went into the model portfolio? Why did you pick those 30 companies, Alpesh, and say they were suitable for me based on their volatility and drawdowns? How did you come to those ingredients? You know, like when you put something in your mouth, you hopefully well, we don't, do we? But we should look at ingredients, shouldn't we? Certainly when you're more health conscious like me. I wish. I tend to look more at, sugars, percentage sugars and saturated fat and all the rest of it. Meta, yes, for the same reason. I think I've got that. Novo Nordisk, not yet. It is one which I will be buying in due course, but not yet. I'm just going to wait a little bit longer until that flattens out on the momentum side, because I anticipate it doing this again. Okay. By the way, we have another simple rule. If in doubt, leave it out. We don't need to have an argument about it. By the way, how do we come to Novo Nordisk? When we go through all of this, okay, we went through all of that, and then we finally looked at some of the momentum. So it wasn't just done on a chart. It was done on value, growth, income, cash flow, Sortino, alpha, all of those things. And we're still waiting to jump in. UBS is more than happy for you to buy. Cantor Fitzgerald's more than happy to buy. I'd rather just wait a little bit longer because I'm cheap like that, and I might be able to get it at 64. I want to make a deal like Donald Trump. It's at 69. I want to see if I can get a deal at 64, if I can buy the company out. Okay. I'm not going to go through all these lies because I've told you this before of the lies that fund managers tell you. It will take up too much time. We're already past the 10 o'clock. My job, twofold. Either you're picking from a filtered list, make your own if you wish, but if you do, please look at valuation, growth, income, cash flow, some measure of cash flow, please. And Sortino, not Sharp. Sortino's a lot better. And then we throw in what all these people say, all the data we can get our hands on, okay, filter it, and then if you're then create a model portfolio, which you might hold for 3 to 5 years, okay? If you want to do it shorter, you could do 12 months and a 25% stop loss. The danger with that is you're only giving it 12 months and a 25% tight stop loss, but that gives you more control. There are 10% of people who are more into control, and that's fine as well. This is the goal that we're all after. Now, this is an example if it were to give you 5% more than the average market rate, the S&P. If it were to give you 5%, not guaranteed you, but if it were to, okay, then that's what happens. Contributions are down here, and that's the returns. That's what we're after. In reality, and this is my son's ISAs, it would more likely go like this. It's just the nature of how things move. The idea being, by the time, well, in 3 years, he's already over here now, 7. God, I think when I started some of these webinars, it was down there. So yeah, that I've told you before. So let's have a look at what a model portfolio is. That's all the sensible, reasonable, likely annualized returns. Something from as low as 10% per annum, because below 10%, what's the bloody point? You might as well speak to St. James's Place if you want something as rubbish as below 10%, which is below the market. So you've just found a new way of losing money. Up to 30, more than 30% per annum, that ain't going to last. It's going to revert to mean. Okay, you might get a good few years. I mean, I only will look for companies which I think have a realistic prospect of hitting a 40%, but chances are it's not going to happen consistently. You're aiming for the moon so that if you fall short, at least you're still falling short high. And then volatilities. I have not created this portfolio yet, the 30% return and the 10% volatility one, which would, on mathematical terms, double your money in 2.31 years. I've not created that yet. It doesn't exist. Can't do it. If I do, I'll get the Nobel Prize in economics. The closest we've got is that, and with that mixture, which isn't bad. Now you might say, well, wait a minute, hang on, doubling in 2.3 years, mate, I'm happy with doubling in 5 years. Excellent, because that means you only need 15% market average. Well done. Simple. Don't even need anything. Don't need any help. It's not bad, is it? 15% per annum doubles your money in pretty much 5 years. But what you do want to do is keep that down so you don't get any panic attacks in between. Most people get panicked in between. Okay, so I'll give you an example of the one my wife and son are in, and what we call the Quality 5 Plus. That does not guarantee they're going to get that in the future. I've not even shown them that that's the historic annualized return, because there's no guarantee they'll get that in the future. And each month I look at the returns and I go, yeah, it's in line with historic returns. What more can I say? It's in line with historic returns. Doesn't tell you anything until 5 years are up or 3 years are up. The figure I want to look at is that I need that to be below 20% ideally. This. Now, I don't mind that being 25%, but the fact that it's 13.6, that's history. In future, it might be double that. What you've got to do, here's a little trick. You look at the historic drawdowns and you double them. And you say, am I comfortable with a 26% drop in the value of my home, basically your portfolio? And you halve the returns. And you say, am I okay if I get half of that? I.e. basically a stock market return. So it takes 5 years to double the portfolio, not 3, which is what that implies. Okay, and you go, yeah, I'm happy if it takes 5 years and not 3. Of course I am. You stupid? Of course I am. Fine. Then you've got a portfolio you're comfortable with. Simple as that. Is there any guarantee it will give even a positive return in the future? No, the world could end tomorrow. Okay. Also, the other thing you got to remember is look at how poor the returns, how variable they are, but look how poor the returns can be in some years. 0 in 2022, below 10 there. The variances. Now, what did you do, you genius, in 2023, Alpesh, in 2024? I did nothing. If you've been following my webinars, as I've always said, the market was great. Did I know the market was going to be that great in 2023 and 2024? No. I keep saying it. Keep telling you. I've said it before, and I'm telling you after the event. I did not know 2023 and 2024 were going to be that amazing years. I'll tell you which year I thought was going to be amazing. 2022. Was it? No. What I think is irrelevant. I do what the computer tells me. And the computer said in 2022, hold cash. Although granted, it said hold cash in February to May of this year. And well, actually, that was a good thing to do because it bloody fell so steeply. Whilst we look at all of this, you don't have to. All right. What a different growth rate makes to 100K over 15 years. Now, this is why it's important. Over 15 years, here's what 100,000 grows into. 5% per annum, 207. 15% per annum, 813. Forget this 30. Forget the 30, okay? Because that's winning the lottery. If you do that, well done. Congratulations. Okay, so just forget that. Chaz, exactly correct. I think what you'd do is if you got after 3 years, you hit your target, you'd probably say, I'm going to sit out the next 2 years and just take bank interest. Why would you get greedy? It's like, if Vegas gave you a bumper return, you wouldn't say, well, let me just go back in for one more go. But it's a problem. I always say, don't worry about hypotheticals. Answer them when they actually become reality and you need to deal with it. Okay, so 15, which is the market average. US market average is 15. UK market average is 5. Okay, roughly. So it's up to you. I mean, you might say, Alpesh, hang on, why are we wasting our time on air? We could have all you're saying is just buy a bunch of US companies rather. Makes life a lot easier. I said it in the Financial Times column, the very first one I wrote in 1999. By the way, I'm going to let you into a secret how I cheat. The average positive return is 32% in stocks over a 2-year period on the S&P 500. And those positive returns happen 88.5% of the time. So 88.5% of the time, I'm right. Because the market makes me right. And over a rolling 2-year period, I've got this massive tailwind of a 32% from the market itself. Warren Buffett said the same. He's been telling everybody ever since. He said it in the annual meeting. He said, thank you, Apple. Tim Cook's made me more money for Berkshire than I've ever done myself. People don't listen. What they do is they keep attributing to him, despite however many times he says, it's not me, it's America and it's Apple. I'm telling you the same. It's not me. It's America and it's the market. It's not me. But people won't listen. They go, no, it's you. You're the guru. You're the pundit. Being Indian, it's quite funny being called a guru and a pundit. Now, here's some stocks which have had phenomenal growth rates between 2013 and 2023. Will they continue having them? I do not know. But do such stocks exist? Yes, of course they exist. Do big name companies that are familiar exist? Yeah. I do own that, by the way. I have owned that in the past. I can't buy everything. I'd be happy to own it today if I had to. I do own that as well. Okay. Yes, I have. Too volatile. I just can't be asked. I know it'll do well. Forget it. I just don't. Even I can't take that roller coaster ride. It's like going to Alton Towers and my son saying, "Come on, Daddy, let's go on that." The vampire triple inverse diarrhea causing vomit inducing roller coaster. No thanks, son. I know I'll come out alive, but I don't want it. That's Tesla stock. Yes, I've got that. Okay. Top stocks with over 30% return per annum. CAGR annualized returns. Okay, 2015 to 2025. These doesn't mean they still will. I don't own something. I don't own Shopify. I don't have Argenx. I don't have FICO. I don't have Builders First Source. I don't have Tesla. Okay, don't have that one. Right, just so you know, because they weren't on the green approved list. So I go by that. And be careful before you think just because they've done that in the past, they'll do it again. Be very, very careful of making such a basic, simple. The reason I'm showing you them is to say to you, they do exist, but there's so few of them. That's why you've got to be very careful and gradually go in and not just have those for these warning reasons as well. Right. Next thing, take a picture of this. How do you sack your IFA? For those who want to sack their IFA and are too scared because it's a friend of the bloody family and they've been losing you money and earning you more and earn themselves more in fees than they've generated you in growth, which is usually the case, this is the letter. Or this one, especially if you're a client of St. James's Place. Okay, so we've written it for you because we've had to write it for so many bloody clients. We just got fed up and said, do you know what? I'm just going to give you the letter. That's it. Take a photo with your camera phone. Okay. You can just take a photo and it's job done. If you want to see the results, 2024, it wasn't me, it was the market. That was it. Why? Well, the market did a big chunk of that. I didn't do 41%. Well, we did, but the market did it. Okay. And those were just some of the stocks. That was ridiculous. That's never going to happen again. Because if that happens again, I would say that there's a parallel universe I'm living in. It was the market, and the ones we had just happened to do incredibly well. I'm sure there'll be years where the market does really well, and the ones we have, for some reason, just don't. That'll happen. It's happened before. It'll happen. It'll happen. Well, it's rarely happened, but it'll happen. But that was 2023. Guess what? 2022, 0%. Zero. Why? We had to be in cash most of the year because it was what we call a daddy bear. Happens rarely. Thought it was happening this year. Didn't. It's fine. I'd rather pay the insurance premium to be out and wait. But that was zero. So just so you know, zero. And that's fine. That's why you can't pick 1 year. Tons of stuff there. Okay. We haven't finalized this ad. It's a mock-up. We're going to do it. We're going to finalize this advert particularly, and it's going to look like this. And we've got several individuals that we're going to put on for this. But anyway, just so you know, this is the advert that's coming soon. You're going to see a lot of it in different places. I don't know, we might even put it on a big billboard on the A40 so I can see it every single day. But that's coming soon. I have got a bit more. Just be careful with St. James's Place, okay? I other than 2 people, they've got about 1 million clients and they're a FTSE 100 company. They're great at advertising and marketing. Their latest advertising gimmick is completely rename all the funds, start from scratch so that there's no history, because the history was shit. Okay, so what they've said is, no, we can't tell you how we did in 2022 because those funds don't exist. We've got new ones now. Honestly, they get away with it. Okay, it's a good marketing trick. The problem has been there for a long time. So I've said it. You know, it's institutionalized robbery, how it happens. But in the industry, in the city, it happens. You get away with it. Valuation, these metrics, if you're going to do it yourself, if you don't want us to do it for you and give you all the data every month, then these are the things you want to be looking at. Not all of them. You can pick one from each. Okay, pick one from each, but at least have something there, okay, from each of these, so that you're filtering for every factor that could impact a company. That's my first column in the Financial Times, 1999. I've been doing this for a hell of a long time, my friends, and publishing my work in the Financial Times as well, including my weekly views. And that's where I said I'm buying US stocks. So this whole thing is not new. 26 years. 26 years this 9/11. Okay, that I've been saying the same thing consistently. So forgive me if I've bored you at all. I've shown you that before. If you want to see the reviews of clients, you can go to a whole dedicated website where you can see the videos and case studies and all the rest of it. Now, if I've shown you how to do it yourself in broad terms, I'll answer questions in a second. If you want us to do everything for you, but not give us your money, you manage your own capital. You manage your own capital, and want the hand holding and only want it once in a lifetime fee, because we don't charge subscriptions or anything. Because what we want to do is replace St. James's Place. We want to be floated and be on the FTSE 100 and replace them by making sure the client has the data and the knowledge so that they can take my place on the BBC. They can say, right, I like this portfolio. It suits my drawdown. That's what I'm going with, rather than an IFA spraying and praying in a load of funds which are unsuitable. You pick from the stocks, and we handhold you and show you and educate you and inform you. We give you the education and the information, and then run the numbers for your model portfolio and say, yeah, the annualized, that's what that's generated. Doesn't mean it's guaranteed to in the future. These are the drawdowns. These companies tick the value, growth, income, cash flow box. So now you know what you own, why you own it. You understand why you own it. You know how it's done in the past. You see the projections into the future and the returns, and it meets your goals. Boom, relax. And here's a process for you to handle. So we wanted to turn everything on its head and give you the data, make you the expert. But by turning everything on its head from what St. James's Place does, it meant we couldn't charge you fees. It meant we couldn't keep hold of your money. It meant you held your money. It meant you chose whichever broker you want. But we made it simple enough for you. And that's what I do on these webinars. I ask people in groups of 10, because I'm mentoring them myself, for life, hand-holding them for life, giving them all this data every single month. We've got a team of about 10 now worldwide to do it, giving them all this data and all those slides and know-how and much more as well. So if you would like to join, I mean, this is one way to look at it. If that's your portfolio value and you get a 10% improvement, even if it took a year, 2 years, 3 years, that's how much better off you are. Okay, if you've got that, that's much better off you are. So it should be a no-brainer. And if you've got a company, even more so, because you can expense it and all the rest of it. So that's what it's about. If you've got $1 million, well, it should definitely be a no-brainer. 10% improvement would mean 100K. Okay, that's where you go. It is first come, first serve, strictly, because we do run out of spaces. And any questions, let me know. I'm going to ask you, have you ever thought about putting these on TikTok? My bad if they already are. Yeah, they'll be on TikTok. They are on TikTok. Didn't know that. Is buying a US index tracker fund for a long-term UK pension. Are these specific benefits in choosing hedged to the base currency fund over non-hedged? Roger, if there are, they're minor and technical and nuanced. One argument is that if the index tracker is hedged by the institution, they might be able to do it more cheaper than you. I've not ever been that bothered either way with it. So there probably are some differences. It's probably an ideal one to ask ChatGPT, honestly, to do the research for you. I mean, rather than Google. We used to say Google it. Now I'd say ChatGPT it. I'll look into it for you, because I have done for a client in the past, and it gave a whole list of nuanced things. What you've got to remember is, when you've got, say, $1 billion of assets under management, it's going to make a difference. When you've got even 2 million, but before that, it's probably going to be marginal. Might be a few hundred here or there, depending on circumstances. So I wouldn't. Any questions I've missed? Just put any thoughts on Walmart. Generally a good company, not right now for me. Not right now for me, just because of this data. That's where I go to always. Okay, so for me, but it is one of those which in future I may well own if it bags more of those profits and comes back a little bit later, and Walmart comes around and says, yeah, now we've been making profits for years and the stock price hasn't been rocketing up and isn't overvalued, then I think what will happen is it'll be one which I'll come back to. But for the moment, not one. That doesn't mean if you already own it. If you already own it, you'd hold it for sure. But for now, I would say not for, whoops. Sorry, I'm just trying to get to it. I've got it. I just saw it. Here we go. Okay, Walmart. I'll tell you why in just a second on Walmart. I'm pulling up the numbers. Yeah, it's more the valuation. So if I already held it, I'd continue holding it. If I didn't hold it, I wouldn't at the moment, but it will be one in the future. So I won't worry about it if you've got it. There's nothing sort of worryingly negative about it at all, I would say. I've got some files to give people as well. I'm going to give you a copy of the book as well. Share with me any of your questions that you might have as well. BRKB, again, if you already own it, keep hold of it. If you don't, it's not one right now for me. I think there's been some downward momentum on it from what I remember. By the way, I should say this is where our clients come from for the Great Investments Program. These are where we've got Africa. Sorry, that should say Latin America. I do know where Africa is. It should say Latin America there. It's 5% clients. I think it's Mexico and possibly, I think it was Argentina and Brazil. We've got clients, and then Americas again. I suppose that should be a bit lower down there. For North America is 15% of clients. Most are from Europe, everywhere from Norway to the UK, obviously majority in the UK. And then Asia and Australasia, I should put there. That's how I'd sum everything up in terms of what we're doing. Okay, the strengths is to give you the knowledge with the data, control, support, empowerment, transparency, so you got the data, no ongoing fees, your broker of your choice, your account, your money in your hands. The weakness is there's no outsourcing. You're not outsourcing to an IFA and saying you do it and putting your head in the sand. But you can, if you want, have a buy and forget model portfolio. So you can have the sort of, well, can I still have the benefits of an IFA, which is I don't need to look at it. Yeah. Opportunities, you have a new side gig. You could teach your family, you could leave a legacy of education and information to them as well. The threat, the danger to the future, the past is no guarantee of the future. That's the biggest danger. I was interested in one of your books. Is there one you'd recommend I should start with? On investing, it's Investing Unplugged. You should be able to get it from alpeshpatel.com/links. Thank you, Marguerite. David, thank you. On Trading, Mind of a Trader, and you'll be able to also get that from alpeshpatel.com/links. Both you can download for free. You can buy them in hard copy on Amazon if you wish, but you can download free copies. I make that available on there in any event. So, all this coming in. Thank you, those signing up, and thanks for letting me know. I'll give you a shout out as well. Those coming on board to the program, thank you for that. That's the strategy again in a nutshell. You're either going to go down the approved list, which we give you of 10,000 stocks, 6,000 ETFs, overviewed by me, and unlimited access to me, then further filtered, cross-reference with what hedge funds, which are getting 40% per annum, are also doing, if you so wish, to cross-reference and narrow down even more. Or you're going to go with a model portfolio, of which we have several, and make it bespoke to you. And then again, hand-holding information from me and so on. That's it in a nutshell. Well, make sure to take a look at them. Thanks for all advice. No worries. Investing Unplugged for the investing is good, but I would recommend Mind of a Trader, where I've interviewed, it was 1997, it's my first book, published by the Financial Times. I interviewed Bill Lipschutz, global head of foreign exchange trading at Salomon Brothers, some of the world's leading hedge fund managers. And Bill's boss at Salomon's was Warren Buffett. People didn't know Warren Buffett was head of Salomon Brothers for a while when Berkshire were asked to invest in it. United Health, yes, Raj, not at the moment. Well, if you're already in United Health, you'd hold on to it. If you're not, you'd wait. Same with Novo Nordisk. If you're already in it, you'd hold on. If you're not, you'd wait. Okay, in simple terms, is how to do it. I try and make everything as simple as possible. So it doesn't get, well, if this and it does that and it does this, and if this story comes out and if that story comes out, then do this. Have a look at the campaignfor1million.com, which is also another place you'd be able to link and download the books and everything else. You'll find that very useful as well, the campaign to teach 1 million people how to invest. I'm going to give you a few other sites you might want to look at. We've had a lot of very good reviews. Okay, you can see these on alpeshpatel.com. Let me just go down slowly. There's a whole ton of them. Okay, but you can see them all and their links to them. So they're all over there. What else have we got in terms of questions? I think we're okay with questions now. So I'm going to leave it at that. For all those who signed up, I am going to thank you. I think we've got 2 places left. I'm going to send you an email in a second and we're going to get started. And you'll have access to the Excel and the PowerPoint. For those wondering what the PowerPoint looks like, it's some of the slides I showed you earlier, which is the simplified version. Then we're going to have our first onboarding call with me. You'll have an onboarding call with me, and then we'll get working on the route you want to go down, the approved list or the model portfolios, and then create a bespoke model portfolio after educating you, informing you, and all the rest of it. So there's a whole bunch of nice things on here as well, just generally both on the Great Investments Program and on all the free education and stuff. alpeshpatel.com. So you'll see a whole bunch of stuff. You'll also see reviews for people on the program there as well. So you can see reviews, videos, and case studies, actual case studies as, whoops, load more as well. And we're always loading more case studies as we go along. So there's a whole bunch which will be added as well to all of that. Okay. Any other questions? Yeah, Kay, you've asked about on the leverage point. Warren Buffett is against it. What it means is he's against leverage when you're talking about 3 times, 4 times, 5 times, 6 times, 7, 8. Proper derivatives leverage, which with Forex is 100 times. What I'm talking about, the de facto leverage he uses is if you borrow. Let's say I've got a and I'm going to give you a really good, clever example here. Let's say I want to buy Microsoft, and let's say I've got £1 million. I'm going to keep it really simple in my portfolio. And I think to myself, you know what? I think Microsoft will do well over the next 1, 2, 3, 4, 5 years. And I buy £1 million worth of Microsoft. And I think to myself, well, hang on. I don't think Microsoft's going to drop 50%. And even if it did, I think it'll recover. Okay, 2 pretty safe assumptions to make. And I don't need the money back in a year or 2 years or 3. So I think to myself, if I don't think it's going to drop more than 50%, then why don't I borrow an extra million and buy £2 million worth of Microsoft? So if it drops 50%, okay, I've got £1 million, but I'm still willing to wait. And if it doubles, then I've made £2 million on my initial million. It's doubled. I've not just made $1 million. If it doubles, I've made $2 million. Okay, so I've turned 1 million into 3. That's a very simple example, a dangerously simple example. That's what he's done, but not 2 times leverage. He's done, I think it's something like 1.3. In other words, he's borrowed money, not out and out leverage. It's just money's been borrowed to put more into, say, an Apple, because as an institution that big, you can get very cheap rates of income, not let alone the fact that the insurance business generates cash flow. So you're going to get and your Berkshire Hathaway, so you're going to be able to borrow at pennies in interest. So it makes sense to buy more of Apple than just the amount of cash pile you've got to boost your returns, but not by 2, 3, 4 times. So it's not proper leverage. It's 1.2 times. It's puny. It's tiny. Okay, leverage, but it's still leverage. But yeah, that kind is sensible. He probably wouldn't even call it leverage. He'd probably just say it's just efficient treasury cash management. The reason I didn't buy it, because I think I might be able to pick it up a few pennies cheaper. That's all. I don't think it's going to fall or crash or anything. I think if you were in a rush, you could buy it today with Apple. Okay. It'd be more like smart people leverage sensibly. If not, you shouldn't use it. Yeah, exactly. It's the reason Warren Buffett often puts things in extreme terms is because he knows he's speaking to a large audience, and it's dangerous what he says. So I'll give you another example. He says, look, for the average person, the best thing they can do is get the S&P 500 index tracker. And he's right. But you might say, wait a minute, that means he's against people owning stocks themselves? How come he does it? Well, he's not against you owning stocks. He's against you speculating and doing things you don't know what you're doing. Okay, he's obviously not against you owning stocks and educating yourself, because they're the 2 things he talks about the most: buy stocks and educate yourself. The reason he says you should buy index trackers is because he's talking to a big audience, and he doesn't want to be misinterpreted. I mean, my God, there are books written 2,000 years ago which are still being misinterpreted every single day by people who are willing to die for it. I mean, you don't think his words could get misinterpreted in his own lifetime? Of course they can. So he's right when he says just buy an index tracker, because he knows the average person he's talking to, if he says educate yourself and buy some stocks, might go and bloody do something stupid and then blame him for it. So he's right. He's right what he's saying, but he's very careful what he says. Alpesh, you mentioned Quality 5 Plus. Are you able to share the plus, please? No, that's for clients only. I've shared a lot of names on here, but the full 37 list I can't, because it's for private clients only. What helps you determine asset allocation if you're 20 to 30? Well, by asset allocation, you mean stocks, cash, for which read bonds, then your age. I'll see if I can show you something. I'll see if I can bring it up. Give me 1 second. One way you can determine, is it this one? Nope, it's not that one. I'm going to see if I can find it. Here we go. Oh, it's not that one either. Sorry, excuse me a second. I'm going to find it. I'm going to find you the asset allocation thing. It's actually from Goldman Sachs Wealth Management. It's not controversial. I've put it in my other books as well, so I'm going to share it with you. By the way, for those interested, again, I don't think I'm breaking any client confidentiality sharing this. Oh, that's odd. Can you see my screen? Yes, you can. Bill Gates. So there you go. There's their portfolios, just out of interest. Asset allocation. See that little tab I give clients? I show them this. I give them this from Goldman Sachs Wealth Management, and I give them this. Well, actually, we've used JP Morgan and Goldman Sachs Wealth Management. So your asset allocation can be that. Now, most people think that's conservative. I think it's a bit conservative as well. Okay, but you could use that. You don't need to worry about that one. Don't need to worry about that. That I've shown you. And that's another way of doing things. If you want to keep things really simple, you can just have the S&P 500 a third in cash, a third in Quality 5 Plus, exit on a daddy bear, and enter on when the daddy bear's done. It's as simple as that. But so we do try and make it bespoke and simple to people based upon their what they're looking for. Anything improvements you'd like me to make, please let me know for the future, and I will seek to make them, or email me. I have no issues people emailing me, telling me how to improve some of this stuff. I know these things can grow because I love it. I'm passionate about it. I better go because it's 10:30. I've been doing this for 97 minutes now, so I better let you all go as well. Thank you all for being on here. Really appreciate it. And I hope to see you all very soon. In person, hopefully, because I'm going to be doing, I think, about 3 things in person in July. So I will try and broadcast that on the public Telegram channel. If you've not been to the public Telegram channel, please do. If you've not been to alpeshpatel.com/shares, do /shares. That's this site, which will show you a whole bunch of what we do, how we do it. But also, more importantly, will show you, see these, they're good educational materials. So I'll show you a bunch of educational materials. Okay, so have a look at that, alpeshpatel.com/shares. And don't forget, YouTube channel, do follow that. Tons of videos on there, including my TV appearances, and all the rest of it will be on there as well. And the web exclusive is open to everybody. It's there, and you can do by installments if you wish, and it's lifetime membership, one-off fee. Okay, why did we do it that way? Well, because we'd have a conflict of interest with you if we did it any other way. Because if we did it that you keep paying fees, then we'd have to keep trying to tell you, even in a falling market, oh no, keep buying this, buy that, buy this, buy that. Here, we can just say, no, we'll tell you how things are and how we see things. Okay. And I think that's a lot fairer to remove the conflicts. The only way we could remove conflicts, don't get me wrong, I would love to constantly have subscriptions forever like an IFA. I think it's a great little gig that the IFAs have got, but there we are. LinkedIn, do follow me on there as well. I am a top voice on LinkedIn, 26,000 followers now. We've got quite a few there, so do that. And I mentioned before, at Great Investments on TikTok. I don't know if you're aware of all these, and that's where the links are. Okay, so 434,000 followers on TikTok, so you might like that. And there's a load of videos that come on regularly to give you bite-sized stuff. And this whole webinar will go on there as well later today, and it will also go on YouTube as well. Okay, so just so you know, it will go on in both places. Thank you. Thanks to everyone who signed up to the program. I will send you that email shortly. And I think we're out of spaces as well. So sorry about that. I'll let you know when next on or next batch I will take on. Let me close that one and close this one. And I should start saying goodnight. So thank you all for your patience and being on today. I appreciate it. Here we go. Thanks, everyone. And yeah, good night. Good night. Thank you all. Oh, Marek, crypto is something you never seem to talk about. Is there a place for it in a portfolio? I think there's a place for it. The reason I don't talk about it is if the word is used on social media, you instantly get sort of banned and all sorts of awful things happen to you on social media. I don't know if you know this. So if I were to talk about crypto on TikTok during a live session, the algorithms will pick up on it and they'll shut the live down and give me a warning that I've talked about it, because it is so associated with scams and all the rest of it. That's why I don't tend to talk about it. And not only that, if I use the word crypto, then scammers will go into my comment section, reach out to followers and say, oh, you really want to know about crypto? Let me tell you what I'm in. And then that just gets an infestation on my channel. So there's a whole bunch of reasons why I don't. I do happen to have, for fun, some Bitcoin, some Ripple, and some Ethereum. And God knows what's going to happen. I might end up with nothing, might end up with something great. Like modern art, I don't know. That's all I know. I'm not the person to ask. I treat it like modern art. I did it for fun. That's it, sum total of my knowledge. I do think blockchain is useful. I know this from IT engineers I speak to. I do happen to know that Ripple, backed by Andreessen Horowitz, and Andreessen Horowitz don't tend to lose. I do happen to know that the president brought back the head of Anderson Horowitz of the UK, who arrived here, was working with my wife, and then brought him back to the US to head up his crypto policy. So I know the president's big on it, and I know Anderson Horowitz. Oh, sorry, I should explain who they are. They are the most important significant venture capital firm in the US, probably alongside Khosla Ventures and Sequoia. So if they say something's going to win, I would bet. I wouldn't bet against them, ever. I'm not stupid. Okay, so I know a few other things about crypto. That's it. Okay, that's it. Marek, well, there you go. Don't go near it for that reason. You'll get so many people who you'll see the best subtle scripts. I had somebody call me from Virgin, claiming to be from Virgin Credit Card, and I nearly fell for it. They got through several layers of my defenses before I realized, hang on, this is a scam. The point at which I realized when they asked for 10 digits, the last 10 digits of my credit card. But before that, you think, surely you wouldn't fall for it, Alpesh. No, they were very clever how they did it this time. So they didn't get away with it. But yeah, Jamie Dimon says Bitcoin is a scam. No, I think Jamie Dimon's changed his mind on it, because I was at JP Morgan's lunch, and I thought Jamie Dimon's very popular on it. I might be wrong, but I thought Jamie Dimon said, no, it's not a scam. He used to say it was a scam, but I think now JP Morgan are very bullish on it. Indeed, well, certainly what their private banking lunch said. So I think you can easily Google that. We say Google. I'm going to start saying you can easily chat GPT that and ask for sources. Okay, guys, I really better go for your own sake as well as mine. Whilst I love this stuff, there is a limit. I should go. The artwork is by my son. We're going to convert it into NFTs. Remember those? And probably sell it for millions. Do you do live meets? I do, Manjeet. I've got 3 coming up this next week. On the 17th in the House of Lords in the evening for business people, 200 odd. The invite was put up on the public Telegram channel. I'm afraid it's sold out. On the 14th in the evening on Clean Tech with the RAF, I'm hosting that. The invite was put up on the public Telegram channels quite a while ago. It's sold out. And then I haven't advertised this one yet, but I will do on the public Telegram channel on the 18th, Friday, I think it's Friday, isn't it? The 18th of July in the afternoon in Westminster, not in Parliament this time, but in Westminster, just outside Parliament. I've got an event at Parliament. Then after that, in Crush, which is, I think, at 4 Millbank, number 4 Millbank, ground floor. But I haven't advertised it yet. And the timing I haven't got, I think it's going to be like 2 p.m. But I haven't advertised that on Telegram yet. So keep an eye on the public Telegram channel, and that'll be a meet as well. So yeah, there'll be quite a few. New and improved Bored Apes. Yeah, the whole Bored Apes thing, wasn't that fascinating? Yeah, I definitely heard him say that before. Here we go. So there we go. What do you? Pfizer. I had a look at this recently, and I think it looked pretty good for the longer term, for 3 years. So it's not one I could tell you for the next month or 2 months. I wouldn't do that. But I'd say for 3 years, if memory serves me right, it was one of those where I thought, oh, actually, this would be all right for 3 years. It's one of those. Hi, Juan from Australia. Fantastic. Got people from all sorts of places. So, yeah, thank you. So don't forget the public Telegram channel. Thank you all. I better go. Thanks, everyone. Thank you.